The big break we were all hoping for from Nvidia earnings isn't coming. And honestly, the more I poke around through the data points, the more concerned I am about something entirely different. Yeah, it's the nasty R word, recession, and more of a bearish environment that continues to keep a lid on new all-time highs. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's video. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So let's kick things off on the SPY weekly time frame chart, just because I did mention that R word, and I don't want anyone to panic unduly from the higher time frame perspective. So the overall trend count remains in the upward direction on the weekly time frame chart, with the possibility for a higher set of lows to still form if we can hold this 590 zone. If we break down from there, I would really start to consider the weekly chart trading in an overall range and not necessarily trending in any clean direction. So if we are going to call this a weekly double top, which of course would start to bring in a weekly downtrend, we know that we would need to see a breakdown underneath the neckline, which is much closer to the 580/578 level, and we're just not there yet. So although yes, once again, we are talking about a slowdown and the potential for a risk-off environment, let's not jump the gun from a higher time frame trend perspective. That's the first disclaimer. As we move down to the daily time frame chart though, some glaring issues immediately start to emerge. From a daily trend perspective, are we in a daily uptrend anymore? No, we talked about the breakdown of the base case in the Saturday update video when we said, hey, Friday's breakdown from last week did not hold the ideal higher low here, never mind even setting a higher low over the equal low zone, which was at 599.65. And as we can see through the duration of this week, we've clearly broken down underneath 599.65. That area, if it was going to act as support, would possibly keep, or prevent, I should say, this as overhead supply continuing to weigh on the market in the downward direction. Recall that this is the DeepSeek gap down, this is the tariff gap down. Most of the traders who participated in the auction after both of those single day gap down events, because remember, it was a gap down and there was no follow through on the intraday, right? Most traders who participated after that, you can see, actually have positions that are held from this area up over here. It's not like this dead on the lows was where a majority of the overhead supply exists. So the fact that we're underneath 599.65 on Monday's breakdown, Tuesday spends all session underneath, and today is, this shouldn't come as a surprise, right? We were cautiously bearish in the weekend update video. We were saying, hey, if there's a lower high, that's really what we're looking for to confirm more downside. Is anybody surprised or shocked that there's an upper wick rejection right off of 599.65? We had broken down through the 50 SMA here on the daily. Now we're underneath that level. Of course, it's not a shock to see that act, the overhead supply as an area of resistance now. What was once acting as support is now acting as resistance. A classic, technical analysis 101 flip there. So that, of course, starts to suggest that the daily trend may flip to down, which of course has to precede the weekly trend flipping to down. So basically on the daily time frame chart, any continued price acceptance underneath 599.65 is really, in my view, going to build out nothing more than a possible bear flag near the bottom end of the range. Now, we have to be careful here because, of course, this can go two ways. The market can always go two ways. In one perspective, we have the bear flag, we have the bearish evidence that we just described. And I think there's more supporting evidence as we get through the additional charts today that will align with this bearish thesis. But from a pure play risk-reward trade location perspective, I could also see the argument here that says, you know what? Buyers stepped up here, buyers stepped up here, buyers stepped up here. Buyers could possibly step up here near the bottom end of the range. It's very possible that you could have a range to exploit that looks something along these lines, where the lower box, of course, is your risk, and the upper box is your potential reward. It's very reasonable that from a range or balanced perspective, that could be one viewpoint in the market. However, as we're about to explore, I do believe that there's more of a bearish rotation that's actually taking place here, which is far different than what we saw over here and over here on these catalyst gap downs. This has been natural intraday price action that had sold off without major catalyst causing gap downs through the after hours. This is intraday accepted price, right? So my main point on the daily is, as long as price remains underneath 599.65, I would still maintain a little bit more of this bearish stance with respect to trade location, right? You don't want to be what we call, quote, short in the hole at the very bottom of the move, but it probably makes sense to have a little bit more of that bearish bias. We're underneath the daily 50, and there's still this unclosed CPI gap underneath us. Possible catalyst to get down through that, who knows? Obviously, NVIDIA is not doing anything shocking in the after hours. We'll talk more about that in just a moment, but you can see the bid-ask spread here is at 595.85 by 86, so we're really just unchanged from the opening print, basically. The market's not rallying or doing anything euphoric on NVIDIA earnings. So if we can see maybe PCE, inflation numbers on Friday continue to pressure markets to the downside, something that looks like this maybe sets up a trade, right, where we have risk and reward to the downside through the thin structure to close the CPI gap. It's one idea. Obviously, it's an extension through the lower edge of the weekly expected move. It's one way, like I was saying, to get involved near the lowest low with some semblance of a healthy or proper stop loss that's going to protect you from whiplash back to the upside if it ends up turning into a range trade, which again, I will say one more time because everybody wants to know, like, what do we do tomorrow, right? There's probably more of that cautiously bearish stance that persists through the market. We'll talk about the data points as we move on. So that's the daily analysis here. I'd say your key level, 599.65. So long as we're below that, it's bearish consolidation. If the market's going to make a stand and really try to turn around, I need to see at minimum on the intraday a first step hold over that level. Then maybe we can talk about continued counter trend rotations back up to the opening print and the highs of this balance range from last Friday. That's a conversation we can have only when and if we see sustained price action over the daily key, as we'll call it, at 599.65. So, okay, we've been pretty clear about what's happening here. Let's take a look at the hourly time frame chart. And again, you can just clearly see the change in tone, right? This selling pressure intraday is unlike anything we had seen prior. Yes, this is the DeepSeek. Yes, this is the tariff news. Yes, this is the intraday tariff news, which is pretty aggressive, right? But this is intraday, just pure play, sell, 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 even getting follow through down here on the lows. What I primarily want to bring up is the exact lower high from today's session right off of the level. Right, you got a little bit of what I would say sloppy activity on the Monday session where you crossed through the level, accepted back above, and then closed the day weaker, right? So Tuesday opening underneath gives the bears that edge because of the close below 599.65. But on today's session, opening right at this level, which is basically the Tuesday afternoon, let me zoom in on this a little further, the Tuesday afternoon consolidation, it gives the first idea, the first hint, if you will, that maybe there's some sort of higher low and we can see a counter trend move to the upside. Now, we did see a small counter trend move to the upside, but it was immediately stopped. It was rejected at that key level, 599.65. So just the interplay of the level based on Monday and then today's Wednesday reaction, to me, is much more indicative that the bears are in control here. So on the smaller time frame charts, like the hourly here, I would honestly think with the close back down underneath 595.85, we'll see where we open up tomorrow. So keep in mind that we'll have a little bit of flexibility here. Looks like the market's maybe moving a little bit higher, 595.70 now in the after hours, so right around in here. If we open below this level, I would tend to think that all of the traders who chased this on the long side and are still holding long, right, are going to be massively disappointed on an open under 595.85 that then breaks underneath this area here. This is the first place that the hourly chart was starting to suggest a higher low could form. That's 593. We open underneath 595.85, we break through this set of lows, and I would start targeting the top of the CPI gap, the low of the Tuesday session at 589.25, right? So this is the bearish downside that I think is primarily going to be the first order of operations. If we end up opening over the level, 595.85 here, something along these lines there, I would say that it's possible this turns into a double bottom, but what was the argument from the daily time frame chart? We're only really firm believers in that pattern when and if we start getting price acceptance over today's high of day, which is that major inflection point at 599.65 anyhow. If we were to, so again, an open here, maybe quick draw McGraw can scalp from point A to point B on some sort of long, but the best long opportunity in my view that truly will put a firmer stop to the selling, which again seems less likely considering some of the data we're about to walk through, would look something along these lines, right, where you get the higher low clearly over 599.65. So that's really what I'm looking for here. We can take a look through the lens of Fibonacci. just to see what's happening from this point of view. You'll notice that the Fib 38.2 is kind of it's within striking distance of the 599.65 level. If we were to accept above it, it does sort of put us in Fib no man's land, so we'll take that in stride. We can also take a look at our intraday anchored VWAPs as well, and it's probably worth updating some of these to some of these other lower highs that have been set, but regardless, if we just were to follow this one, the all-time high anchored VWAP, if I hover my cursor there, see it kind of boldens it up, where is that, right? As I hover my cursor, you can see it flashing. It's this one right here. So it's beautiful confluence with 599.65, reinforcing the same technical level that we've been sort of going on and on and on about in today's episode. So very clear technical picture on the intraday, very clean levels that need to either hold or break for us to change our tone, and we're cautiously bearish as we head into the remainder of the week, really looking for these lower highs to persist and continued downside to be the name of the game out of the market. Let's take a look at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally, what I want to focus on most here is today's morning session, where there was an attempted rally, and on the ES, we were trying to see a hold over 6,000, slightly different than what we saw in the S&P 500 cash. But regardless, notice the internals try to go positive out of the tick. They try to go mildly positive here out of the breath. They're even opening over the zero line on the advanced decline line, and the index score is positive as well. The fact that this rally does not hold over 6,000 and instead fails, not just down to the low of day, but makes a new low of day, then closes underneath the opening print back here, is fairly concerning. That is a bearish data point to carry forward, especially as the internals were trying to suggest bullish action off of the open on that counter trend rally. We could say the same thing about the Tuesday session. If I just take a look at Tuesday's afternoon through this, you can see that yes, we close mildly bullish on the cumulative tick, but we're bearish on volume flows. And over here, we're just hardly rebounding off the zero line on the advanced decliner. And this index score is still negative into the afternoon. So have we seen stronger buyers step up in this market? Have we seen any evidence that, okay, the buyers are still in control, we should expect a rebound off the bottom end of the range? It's really not been the case. The market's been dominated by stronger sellers on the intraday here ever since the Friday change in tone that broke the base case as described in the Saturday update video. So all things that I can see currently aren't really suggestive of a huge turnaround for the end of the week. I mean, sure, there might be these counter trend pops here and there, but there's nothing really that suggests, hey, look out, there's a big bullish reversal that's coming in and we're going right back to all-time highs. If we take a look at the market profile, there's two interpretations here. I'm going to lean into one of them as you'll see in a moment, but if you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. First thing I want to talk about is the positioning of the value area and the point of control from today's session. We all know that the market technically closed lower. This is where the market closed, right down here where that white arrow is. I know you can probably hardly see it on your screen. So the fact that the point of control was left higher in the session, the fact that value was higher in the session versus lower, in some cases might suggest that the afternoon breakdown wasn't really the strongest response from sellers. And maybe we should actually be reading the opposite way into it, right? That, hey, this is just a pullback in the context of what's starting to become a higher low opportunity for the market reversal to the upside. Now, although that's not technically wrong and objectively right, you could make that argument because of where the point of control is. This is where the most business took place on today's session, the most transactions. The way I would think of it, especially in the context of those more bearish market internals that we just saw, or lack of bullish market internals, you could say as well, is simply that these are trapped buyers who are overhead supply. Not only, right, if we just quickly flip back to the platform here and we talk about the 599.65 and the overhead supply that exists above that from the daily perspective, all of these traders in this box primarily right here, not only is it that, but everybody who interacted with the market today on today's individual session trying to buy the move over the Tuesday high at the daily 50 SMA, those traders are now trapped as overhead supply on a smaller time scale, obviously, which is why that point of control is here. So sellers were not aggressively, putting orders through on the lows, and instead, anyone who is buying this up towards the highs are now trapped. And that to me makes a little bit more sense with the narrative we've seen so far. Now, of course, and I think we should probably talk about this on the futures chart here as well, we've talked about on the S&P cash how if this is going to turn into a double bottom, right, then fine. Over today's high, which is that key level, 599.65, then great. Everybody's sort of okay on the long side. And just notice how that makes sense logically on this chart as well. If we were to take out today's high, which does technically lack material excess, if we take that out, right? Let's say we open here for tomorrow. All of these buyers are still like, okay, we're not doing too bad. We're still somewhat happy. There's a reversal off the lows, perhaps. This is a great excess low in E period from Tuesday. If we take this out, we will be over the key level on the technical side of things from the levels chart, the candlesticks chart, right? And we'll also be over this, what I'm considering, at least as of right now, in the immediate term, overhead supply. So really, the Wednesday high of day is going to be a key inflection point for our markets. And here in the ES futures, we know this level to be it's an updated level now because it's in between two key levels. We have 60.25. We previously had 6,000 was a key watch, right? As well as 60.45 to the upside as well. So today's high is going to take the crown jewel of the major level to watch for. So that's the interpretation of the broad market through the lens of the Spider's cash. Let's take a look through the QQQ, and then we'll, once we get into the IWM and small caps, I think the recession argument will really start to shine through, and you'll see exactly where my concerns are coming from. This bearish, cautiously bearish stance, right? So on the QQQ, we could do the same thing. We can go to the weekly just to make sure that nobody's sort of confused about the weekly trend yet. I mean, it's still up, right? We have lows, higher lows, higher lows, higher lows. It's very possible that you can get some sort of very nuanced higher low here, pulling back from the highest high. I'm not going to argue that that's not a possibility. It is. Now, if the weekly is going to turn into a double top, very similar to the S&P 500, of course, we need to see a breakdown underneath the neckline, right, the last low in the sequence to bring in a lower low. That's underneath 500, and that's also a breakdown of the previous area of resistance from back here. So on the higher time frames, we're not all the way over the edge to where we would say, okay, like sell everything. The market's going to crash. Weekly downtrend is here. Watch out for the monthly downtrend. It's going to get worse, right? We're not there yet. I'm trying to take a very balanced approach where in the short term, I'm definitely seeing some warning signs, but the higher time frame trends that typically are more indicative of like, yes, a stronger move is or is not happening, they haven't quite fired off yet. So again, trying to take that balanced approach and not lean into, any particular side more so than we need to. On the daily time frame chart, again, we'll take the balanced approach. If this is a balance range, we have seen look above and fail. The target has been hit, which is always the bottom end of the range. It wouldn't be unreasonable for a counter trend move off the bottom end of the range. Range traders are probably saying, no, I want risk, reward. I don't want to be bearish down here at the bottom of the range. I want to be bullish. I get it. From a range trading perspective, totally makes sense. Now, my argument's going to be, as long as price remains here, underneath 522, it's very difficult to have that bullish stance that a counter trend move is really going to come in any strong sort of fashion, right? We're underneath the daily 50 SMA, very similar commentary to the S&P daily. If we were to just divide this into halves, the balance range straight down the middle, it's 522. That's going to be your key level. As long as consolidation remains below that, I would maintain more of the short-term bearish stance, and you could make the same argument as overhead supply existing in this upper box that I've just sort of drawn right up here. We'll just sort of give it a couple outlines so you know which one I'm referring to. 522. As long as we're below that, it makes sense to me that bears can persist for lower highs, and then equal low reattempts to the bottom end of the range really get dangerous for opening up the door to this is an intraday very important level at 506.50, and then 500 is that weekly key we were just seeing on the higher time frame charts. You can imagine weekly left, weekly right, your neckline is down here, right? So there's that. If the market's going to change tone, and again, I will raise my hand and say like, phew, sigh of relief, because like, don't get me wrong, guys, I've got a long-term portfolio too. I don't want to see the market go down any more than the next person doesn't want to see the market go down. We're just trying to interpret the data points. If we get something that looks like this, I'll say great, like crisis averted, no problem. If we're over 522, the balance range lives on, and maybe it's more neutral and we sort of start to, develop some more positive sentiment here, we'll see. But as of right now, it's not really, we're not seeing too much of that, even with NVIDIA earnings, right? So in the after hours for the NASDAQ, you're seeing a bid-ask spread of 515.75 by 76. That puts us 515, whoa, down here, right? That's basically unchanged from the opening print. A lot of upper wick there still on the daily bar and not opening on any semblance of a gap up over 522. NVIDIA earnings is not this big, blockbuster report. Oh my goodness, it's going to finally get the market out of this balance range. The numbers were not impressive enough. The market's used to what we've been seeing, right? And again, we'll talk more about that in a moment. So let's take it down to the hourly. Let's see what we can see over here. One of the things I find most compelling about this on the bear side in particular is just that number one, we did not see a move through the opening print of the Tuesday session to continue retracing the thin structure into 522. If we had stronger buyers involved in the market, you would think you'd get a full test of the level. We did see that in the S&P 500. We didn't see that here in the NASDAQ 100. So that's strike number one. Strike number two is that, okay, if this is a low and this is an hourly higher low, and we're sort of holding that off of the opening rally, then fine. Where's the next ideal higher low? It's just over the opening print, right? You can pull back, you can go to the opening print, but you better not break down through it because you're trying to go low, you're trying to go higher low, and then you're trying to go higher low over the open, over this previous area of resistance at 515.25. So that little, flip that I was talking about, that nice little thing that sides more so with the bears here is the breakdown through the open lower high that gets set underneath. And again, as of right now in the after hours, it looks like we're just hardly struggling with this level here. So the resolution of this tomorrow, in my opinion, will be key. If this is going to be a double bottom, of course, you need to be over the neckline, but that's probably not enough. You probably need to be over that 522, which we just described in detail on the daily time frame chart. So an open that's under 515.25, in my view, is bearish, and I would say that you have nothing more than highs, intraday lower highs, lower highs, lower highs. You could call this floored to the bottom of the pattern, but it's a head and shoulders, right? Where you have a left, a head, and a right. Anything through the neckline opens the door for downside underneath 510, 506.50 is the key level we talked about, and then underneath that, the reason I said it was so key is if we look back, this is not the chart I thought it was. We'll talk about which one I think. I was mixing it up with something from the core list of companies. We'll see what that is in just a moment. Ding, ding, ding. It's Microsoft. Okay. So anyhow, underneath 506.50, I would just expect maybe a grind through this area. Microsoft has a thin structure retracement, which I was sort of making the wrong association in my head, but you get the idea, right? So under 506.50, 500 becomes the key level to the downside. Okay. So that is your QQQ NASDAQ chart in a nutshell. Let's come in here with a Fibonacci from top to bottom. 38.2 could not be any more on the money. Of 522, the key level makes total sense there. And we can quickly check in on the intraday anchored view apps as well. All of them are barreling in the downward direction. Some will start providing confluence at 522 sooner rather than later, namely the all-time high anchored view app. Not a shocker there. So cautiously bearish remains the stance on the NASDAQ, given what we've seen here and the lack of the hourly higher low hold over 515.25. We can quickly check in on our good friends, the nasty NASDAQ internals. What do we see over here? Bigger outflows on Tuesday's session, I think, is definitely noteworthy. Same thing on Monday versus the S&P 500, which was a little bit more, they were definitely still bearish, but they were much more close to the zero line. Today's session does technically close positive. You have positivity here out of the advanced decline line, but again, look at this reversal from what initially looked like a decent move out of the open to reject trend higher zone and close back near zero. It's not like the buyers made much progress there. You could say the same thing here out of the volume flows, right? Just a close, just sort of off the high of day. The cumulative build getting back to flat into the afternoon there. Nothing impressive out of the internals front. Let's take a look at the market profile side of the nasty NASDAQ. And over here, it's the exact same commentary as the S&P, where you have this value area, which is higher in the session. Same thing with the point of control. My first thought is that this is trapped overhead supply, especially given that dynamic into the close of day, not holding the open for the hourly higher low we talked about just a moment ago on the candle chart, right? We are still getting and seeing here a incredibly poor high DEF period straight across the top there on the profile, as well as a lack of material excess on the lows. So a reasonable outcome might be, okay, we open over the 515 level we just saw on the QQQ, we pop the high, come back into range. That sort of sets up a move to the downside after repairing and finishing the auction in the proper sequence at the previous day's high. So just an idea. I would prefer, honestly, if we just go back here to the candle charts on the hourly, I would honestly just prefer straight up an open underneath 515.25, bearish consolidation, and some sort of brigade bolt under 510 to interact with trades here down on the lows. Other than that, an open up here, I mean, you could try to scalp this on the long side, to repair that poor high, but you're really you're talking about quick draw McGraw trades that happen on a 2-minute chart, maybe even a 1-minute chart and a 5-minute chart. It's sort of outside the scope of this style of analysis in the midweek market update video, right? We're talking about the broader zones where the market's bullish and bearish. Individual little trades like that can happen on a whim any given day. So anyhow, that's your NASDAQ. All right, let's take a look at the small caps now, because this is where we certainly have larger concerns around that R word we were just talking about in the intro, recession. Why am I so concerned with this chart? We've known it's been relatively weak to the market for quite some time now. And this is even on the higher time frames, right? If we go out to a weekly chart here and let's just grab like 10 years of data, we all know that we've been making the comparison, right, of how this balance range saw look above and fail, lower high in the range. If you break the low, things got pretty nasty there through 2022, and then you had this sort of like lost period of 2 years where small caps really didn't do anything. So the fact that now again you have this consolidation in this box back here, failed breakout lower high back within. We've been talking about head and shoulders on the weekly time frame chart. This is one component of like small caps not performing with the broad market near the all-time high. That's one component of it. But even more recently, I'm going to skip around here a little bit because I think it makes more sense to tell the story. If we take a look at the Fed tracker tool, and we've been talking about this in the pre-market preps over the last couple of days, one thing that you'll notice is the market's back to pricing in 2 rate cuts in 2025 well ahead of the end of the year. I mean, we've suddenly gone from like maybe 1 rate cut in the September timeframe to, okay, not bad odds, a little bit better than a 50-50 coin toss for June. And, beyond that, another one at 38.5% odds, obviously skewed across different sides here, gives you that probability. But another rate cut now for the September timeframe, where in the earlier stages of 2025, I'm saying that as if it's like, June already and we're halfway through. It's only February, people. The fact that we were maybe considering a singular rate cut here, where all of a sudden the market's a little bit more decisive about 2 rate cuts, and yet, so again, tie the narrative together, the market's getting a little bit more aggressive with rate cuts, but yet, what are small caps doing here, which we know are incredibly sensitive to operating environment, which of course has a lot to do with interest rates, financial policy? They're falling off of a cliff. We want the white crayon back. There we go. They're falling off of a cliff. We've broken down from the new balance range. We've broken down from the old balance range. We're underneath all of this nonsense. We never could really resolve that weekly key level in the upward direction. We're now underneath the daily 200 SMA with an upper wick rejecting that on today's session. And once again, with the fundamental backdrop that the market's pricing in 2 rate cuts in 2025, and this is what the chart looks like. I mean, it makes you wonder, what is the market seeing here when it comes to growth? Is it seeing recession? And again, one of the things I was very intentional about doing in the very beginning of today's episode is starting on the SPY weekly time frame chart. I don't want to be an alarmist, and I don't want to say anything that's not accurately reflected in the charts. But this, how is it inaccurate? Tell me how I'm being an alarmist and like blowing this way out of proportion with small caps not seeing any love on higher odds of 2 rate cuts in 2025. Make that one make sense. It's just, it's not adding up. And there's additional data that we'll go through as well. So on the daily time frame, obviously we can see any sustained price action under 218, really, that's like ultimate bear action, right? Looking for further downside here. Anything that starts to see a counter trend rally, like wouldn't be unreasonable, but I would say certainly just seeking lower highs underneath 220.25, reasonable, fine. Anything that's a little higher than that, there's a gray dotted line level in here that's hidden by the upper edge of the weekly expected move. It's 223.65. That level as well can still offer just a lower high. And then not only is this a big right shoulder on the weekly time frame chart, but you start to get what? Left, head, right shoulder. Anything that breaks under this really starts to accelerate. So where's the level in which I would say, okay, Matt, all of this was like, it was good to flag it. It was good to talk about this bearish threat that's possibly emerging here, but like, let's put that to bed. We're moving on to the upside. If if small caps were to start a rally attempt here and, let's say make it to the top level we talked about and then set a higher low, right? Now all of a sudden, okay, maybe we're a little bit more neutral in a range that looks like this. The time where I would change my tone to saying like, okay, maybe that panic was just a little bit of like premature and we can put it to bed. It's when we make a new higher high. If we were to make a higher high. So not only do you need the higher low first, but I would put the panic to bed, the sort of warning shot across the bow, I would put it to bed once we had a higher high as well. So both components of what's required to classify something as an uptrend, right? You need the higher low first, and then you would need some sort of higher high. If we get both components, I will certainly sort of dial back the bearish caution. But for now, it looks like we're a long way to go, and the daily structure doesn't even look that great. Let's go to the hourly chart here, right? So sure, you had the opportunity, and you still do technically have this opportunity. Where's the market opening or slated to open now? 216.25s. So give or take right around in here. Not all that not all that unchanged from the settlement price. I mean, if it holds in here, I would take it, yes, the first pattern I suggested was maybe inverted head and shoulders, but really, I mean, let's be honest with ourselves. It's a bear flag, right? And any sort of like continued lower high acceptance down here, this opens the door for lower 214.50 to 10.75. Right, and that's the possible downside that we're looking for. We will be cautiously looking for intraday opportunities on the upside if we start to see this, right, as a tailwind for the S&P, but it's not, let's go out and buy small caps with both hands, right? Let's take out the Fibonacci's, excuse me, here from the Friday session high to the low. 38.2 is spot on our 218 level, so all set from that perspective. We can also drop in the intraday anchored view apps, although the anchor points here mean a little bit less in our much choppier market. So you still get DeepSeek, you still get tariffs, but aside from that, just noting that you're underneath the entirety of the stack, and the one from right here is the closest to that 218 daily 200 SMA, Fibonacci 38.2 as we just saw. So bearish consolidation here. This is sort of like top of mind, cautiously looking for upside tailwinds, intraday scalps only for the S&P if that's the case there. All right, that's that. Let's quickly check in on the Rusty Russell internals side of things, and we can see, bearish Monday, Tuesday, neutral and flat today, neutral on the internals advanced decline line for the Russell, but big bearish on the cumulative tick for today's session, which is noteworthy, especially remembering that all of the indices really saw that opening rally, tried to get acceptance over the previous day's high, and no love there into the afternoon, setting that lower low and then closing underneath the opening price as well. If we take a look at the market profile for the Russell, let's jump on over here, and we could do this just fine. What have we done relative to this thin structure retracement from Friday? Right, not much. How one of the exercises we talked about on the Saturday update video was, and if I think, where's the drawing tools on this? This is one thing that I'm not always as familiar with, the drawing tools on, it's over here. We want a Fibonacci retracement. There we go. Tradovate. My goodness. What we wanted to do was just see how much of a retracement we got into the Friday range in particular. Nothing else, just Friday's range. Well, you can see Monday, still under in this case, 61.8. You could flip this obviously for 38.2 underneath the Friday range, and even on today's little retracement in, still well underneath the key level there. So has much progress been made for a counter trend move? The answer is absolutely not. This does look like a bearish acceptance near the lows, which sort of aligns with the thesis we've put forth so far in today's episode. With that, let's jump into some more supporting evidence here that I believe aligns with the cautiously bearish stance. So the first thing we can look at is the weekly performance of the S&P sectors. Leading the pack is not a sector, but the TLT bonds, right? Up 2.94%. Rates have fallen off of a cliff because bonds have gotten a bid, notes have gotten a bid, and this is classic, right? Pre-2022, classic flight to safety style behavior, where money comes out of equities into bonds, as big banks, institutions, so on and so forth. They can't just hold cash, right? You just can't hold dollars. You have to be in something. So TLT, the bond market, getting some love here, is seeing the outflows of equities into bonds, and again, that's a defensive posturing mechanism for these larger firms. So that's strike number one. Real estate as a hard asset is definitely a bit more defensive, I would say, towards the top. But as we've seen anecdotally through the headlines and even in some of the data into the end of last week, I mean, new home sales are down, existing home sales are down, mortgage demand is down, even as rates are plummeting here a little bit. That doesn't really align, and we'll take a look at the the XHB home builders, which have been a warning sign for a couple of weeks now, we've been talking about. Healthcare is third, and we all know that that's a defensive sector, right? Materials, lightweight sector. Staples, defensive sector. At the bottom end of the barrel, it's the semiconductors. Energy is a little bit more of a neutral stance in terms of risk on and off. Communications are risk on, that's towards the low end. Technology, discretionary. All of these are heavier weight risk on components for the market. So to see the posture this way really doesn't strike me as a risk on environment. Hey, let's buy the dip here on the S&P 500, right? It wouldn't really make sense until we start to see some better performance from things like semiconductors and the tech sector, which as of right now doesn't look like Nvidia is any help. Let's jump through these quickly. TLT is off to the races. That short put position down here in hindsight is like, wow, we should have just bought long calls at the same time. There's always something to do in hindsight, but regardless, TLT up big time, also breaking out through the trend line we had acknowledged a number of, at this point, weeks ago as it was starting to form after the higher low, through it on the second attempt. Beautiful, solid little move there out of the TLT. But once again, thinking about what it means for the posture of the market, it's definitely a defensive rotation. If we look at real estate, trying to get a little bit of love over this with rates coming down a little bit, but again, home builders, the XHB, let's take a look here. Really not seeing much of a strong counter trend move after setting a new swing low underneath this low into the end of last week. Monday actually made a new low this week, also closing there as well. So all things considered, not really doing so well out of home builders. Another thing, I don't know what the I guess the Dow Transport would act as a good proxy for this, and we could take a look at that eventually. But if you look at shipping companies, they're also not doing well. So FDX, in terms of like freight is down. It's not trading near all-time highs. You could look at UPS, not doing well either. And these things can just like generally be thought of as a proxy for the economy, right? LEN for Lennar, a home builder by itself, of course. So what's the other one? DHR? DRI? Is it DRI? DHR? Oh, I'm going to butcher it. You guys know what I'm trying to look for. DR Horton. DRH? Where is it? I don't know. I'm not going to spend time waste your time looking for it, but let's just move along to healthcare, right? Generally, the point being is that the cyclical side of the economy does not look like it's doing so well right now. Healthcare, inverted head and shoulders breaking out. That's fine. It might save the S&P 500 from falling off of a cliff, but it's not. It's D for defensive, right? This sort of breakout here is not going to push the S&P 500 to new all-time highs if the tech sector and discretionary sector and even financials have been lagging quite a bit recently, pulling back from their highs. If those aren't participating, this is like, again, it maybe prevents like an all-out crash in the S&P, but it's not bullish. Let's take a look at materials. Unchanged inside of the range after a look above and fail. XLP is consumer staples breaking out here. Again, you can see that relative strength. Yes, it's upward pressure, but obviously in the face of semiconductors the way they are and the tech sector the way it is, not enough, right? Not enough. So this is risk off posture in my view. If we look at the SMH, we all know that this range, a lot of anticipation with NVIDIA earnings. Like, can we break out of the box for once? And the answer is apparently no. We are not breaking out to the upside or the downside. And that's one thing to acknowledge here in the intro. Hopefully nobody sort of misinterpreted the NVIDIA request to like everybody's hoping for a break, right? Break just meant in either direction. Just get us out of the range. Start giving us some better opportunity here out of semiconductors. Just not happening. It's just not happening. So neutral there. Energy, not much to say. Midpoint of swing highs, compression of range, so nothing going on there yet. Communications failing back down, and in today's upper wick actually rejecting the previous all-time high does look a little bit more bearish to me. On the intraday, you could probably build the argument for like a right shoulder starting to form here, and then a thin structure retracement to 99.15 acting as bearish pressure. The technology sector, so just the one sector to rule them all. We talked about it, right? There was no higher low in this zone. This is ideally where the market should have found buyers if this trend was going to attempt the breakout to the top side. Just no love there. So currently sitting at the bottom end of the balance. Again, range traders probably want risk reward back to the upside. I have some reservations. NVIDIA's not looking so hot right now. We've seen Microsoft on a big breakdown. Tech doesn't. It looks slow. The market looks slow, just like we were saying for a long while. Like, hey, the market's tried to break down a number of times on these gap down catalysts. The market tried to break out up here, had the opportunity for a higher low, and couldn't make anything happen. And that was after a number of failed bearish attempts to the downside. So, like, as we say in the live stream in the morning session, right? TG. The gift just keeps getting passed back and forth from the bulls to the bears to the bulls to the bears, and really no bold calls until we get out of this range here in not semis, but rather the tech sector. XLY, Tesla is absolutely bleeding out. Amazon's not helping over the past couple of days either, triggering a double top through the neckline here. Rejection. The big threat, of course, is underneath 212.50 for continuation to this gap close. It makes a little bit more sense given where the posture of Tesla's daily time frame chart is. We'll take a look at that in just a moment. This to me would be the place to say, okay, is the pain over? Is it possible that buyers step up here? Is there some sort of reversal off the daily 200? We haven't tested that in quite some while. So gap fill reversal, retest of this breakout point. Be very interested to see what happens with the XLY off of 203. Obviously, to get there, there's some more pain ahead, but if we can get there and if we can form a bottom, maybe that acts as a new foundation to build the next move from. Speculation at this point, the daily chart as of right now, as long as it's accepting underneath 219.75, would remain more bearish than bullish. Let's take a look at utilities. Sideways, if it's over 77.50, maybe some outperformance, but not going to make or break the market there. Financials, not really getting the love in the bull flag, right? This bull flag here. For the breakout, you can see that we broke down from it through the bottom end of the flag on the Tuesday session and getting an upper wick rejection today underneath 5150. So a continued move underneath 5070 should bring in thin structure retracement. And again, the way we could think of this is like if these pullbacks continue to develop, maybe if the financial sector gets here and if the XLY gets to its, 203 spot we were just looking at, daily 200 SMA, maybe that's where these next launching points come from, the next big bull base forms in the S&P 500. But to get there, we need a little bit more pain first. So that's kind of what I'm seeing through the sectors. Industrials here remain bearish as well with the lower high, unable to continue to persist with those higher lows. Obviously, we've broken down. So another lower high is just the nail in the coffin, and I would continue to expect bearish pressure here out of industrials until the trend actually changes on the short term. Let's move into our ratio grid because this also signals risk off rotation. As we're taking a look through this, the XLK is not doing anything to help. This is not doing anything to help. Financials look okay. We'll give this a squiggly sort of check mark like that. This is D for defensive. This is risk off. This is risk off here, building a nice little uptrend. Communications are hanging in there. I'll give them a neutral tilde there, but certainly this dashboard, you're only looking at one check mark from financials. And as we just saw on the actual candlestick chart, doesn't look that great. So leaves a bit to be desired on the risk on front. If we take a look at some specialized ratios, this gets an X, this gets an X, this gets an X, and this gets an X over here. This gets a big old X. ARK-K, the innovation fund, this was like maybe one of the most deceiving breaks I've seen in a very long time, where it looked good after a long-standing rounded base, consolidation, you could call it cup and handle, whatever, completely failed the breakout here, immediately back down underneath. That, tough, of course, but nonetheless, reading into it and walking forward, that has to be more of a risk-off indication. As we take a look at the Dixie, to get a little bit more fundamental here, we'll start talking about rates, although we did look at the Fed tracker tool already. Pulling back, it looks like there's an opportunity for maybe a higher low to be set here or just continued consolidation. I wouldn't read into the dollar too much. I think that rates, and obviously they're somewhat tied together, so you could do that. But I would think that this gold chart actually is more telling and supports the bearish thesis we've put forth. Remember I think it was now 2 weeks ago, we were sort of talking about back here, if this is going to roll over, that would help the risk on sentiment for the S&P off of this known area of resistance. Well, of course, what has happened, we've broken out through that. So what does that mean? Flight to safety. Flight to safety here into gold, the hard yellow metal, the one everyone loves. I mean, that's pretty defensive in terms of posture, and it would sort of look similar to if we just skip ahead to the TLT ratio to the S&P in terms of risk off ratios. This also breaking out. Let me even zoom in on this, right? We had talked about on Saturday, if this holds a higher low and makes a higher high, that's where we're like, hey, red flag at this point. Let's shade that in red here so that way accounting doesn't get on us about the CRAN budget. That's a red flag, right? And I would say that marries in nicely with the gold analysis and the ratio that we just looked at over there. So as I said, I don't want to be an alarmist for the sake of being an alarmist, but the data points currently suggest, like, as rates are just falling off of a cliff, small caps are not performing. Gold is outperforming as a risk-off indication. Bonds are outperforming as a risk-off indication. I don't want to say the writing's on the wall because I don't want to sort of make it seem like, big crash has to be coming, but it does seem like cautiously bearish is the right stance here, especially with NVIDIA earnings unable to sort of break the market out of this in the upward direction. This is the inverted ZT, the 2-year yield, basically is a proxy for that, just signaling, again, as this moves to the downside, the fact that 2 rate cuts are being priced back into the market. So not a shock if we go back to the Fed tracker tool that, again, we already talked about this, so no need to rehash that. If we look at the calendar here, it's all about PCE into the end of the week. One of the things that I think is interesting, because I maybe have perpetuated this a little bit as well, is the idea of the jobless claims, meaning like, the market's fine, the labor market's fine, there's no issue there. I mean, the labor market does look fine as of right now, and the jobless numbers have not done anything out of control, but the way that the other intermarket interactions or relationships, I should say, are acting is more of a warning sign here. So I don't want to say that it's going to be a leading indicator that the unemployment claims will get worse, but if this does start to trend in the upward direction, it would just be another data point to carry forward inside of this cautiously starting to hint at the R word style analysis that we've done thus far. Durable goods, unemployment claims, GDP on the Thursday session, but again, PCE strikes me as the big one for Friday. Let's talk about earnings, right? One of the things we talked about on the Saturday update video is the $2 billion beat and raise phenomenon that NVIDIA has set forth. I can't remember, did we talk about it in the video or did we put it out in the newsletter? Either way, the beat and raise, you can see here in this column, has been consistently around the 2 billion to 2.5 billion mark, and the results, as we take a look at this over here, we did see that, right? So let's use the gap numbers. That's fine. They're actually the same here, and here. I wonder if that's a typo. I would think not. Yeah, it's not. So it's the same. Anyways, revenue at 39.3 billion, which is, this estimate might have been off a little bit, but if you just measure from this, right, the raise, it's certainly within striking distance of their guidance that they offered. So that has sort of come in at expectations, and then the guidance going forward, I believe, where do I have that one? Oh, I had it in here somewhere. We can find it on X probably real quick if we do something like NVIDIA guidance. Let's try that out for size. Let's see, guidance. There was an image of this that we're looking for. It's right here. Revenue is expected to be at 43 billion. So what does this sort of suggest? They're sticking with their pattern of the $2 billion beat and raise, right? So that's sort of their raise there is from 40, let's round up, right? Let's round up, call it 30. Actually, I suppose we should round down. Yeah, let's call it a $3 billion raise that they've offered basically here from 39.3 to, what was it, 40 point something, 43.0. So, 2.7-ish billion dollar raise there out of NVIDIA's outlook. The market's familiar with this game, right? So why are NVIDIA earnings not like sending this through the roof? They came in at expectations, they hit the earnings number, they offered good guidance. The market knows this game. There's no surprise left here. There's no like investors are shocked and awed by like, wow, NVIDIA does it again and they offered $5 billion of guidance raise. That would be what it sort of takes here to get this out of the rut in the upward direction. So that's what we have out of that. This is really going to put a bow on earnings season. There's really nothing else after NVIDIA that's overly important. So it's sort of going to mark the end of the season there. Let's get back on over to the charts. And I suppose before we jump into some of the additional supporting evidence like breadth, let's just look at NVIDIA on the technical chart here before we do anything else. So again, the numbers came in fine. I'm not suggesting that there's an issue with the numbers. The numbers seemed healthy and on par with what the market expects. But when you give the market what it expects, you're going to get no change through the overnight. There's really nothing interesting that was discussed on the conference call either. I was listening, through a majority of it, and then as the Q&A started to wrap up, I was like, there's nothing here. May as well start doing the video for the midweek right now. Why wait for it to end all the way? There's no special sauce. NVIDIA is not, there's nothing big. So no nothing. We're in the grind. We're in the February grind. The risk off rotation appears to be real. Let's take a look through some of these other supporting evidence points, and then we'll get you on your way for tonight's episode. Bonds relative to themselves rolling over a little bit here, just sort of indicative of the shorter end of the curve versus the longer end of the curve, which makes sense if we're going to go into a more recessionary style market. Let's take a look at credit spreads. This will be the last domino to fall, perhaps, where if credit spreads start to widen in a material way, that would definitely be the nail in the coffin for the R word. So watching these quite closely. They have not broken to new highs relative to these last major pushes that we've seen out of the market. So this will be something that I am watching very closely over the next couple of weeks. As we move along to the HYG in isolation, it is technically divergent from the S&P 500, but again, think about this from a money flow perspective. If you're trying to reduce risk exposure in equities, yeah, I get it that you probably want government backed, and that's going to be the true reflection of the air quotes risk-free rate, right? But even a more defensive stance than straight up equities might be like junk bonds in an aggregate sort of basket like this. And if you don't like that, you could go to LQD as the corporate grade. So like if you're like junk bonds, those aren't safe by any, like corporate grade, here's your corporate grade LQD, still making a move in the upward direction as well, divergent from the market downdraft that we've seen. So there's that. Let's take a look at BTC, which of course is breaking down as well. So the risk off signals are straight across the board. Crypto's not safe. Big breakdown of the 92,000 bottom end of the flag in here. I don't see crypto as a defensive asset. I don't see it as a hedge to inflation. I'm not going to say it moves at parity with the NASDAQ, but it's certainly a risk-on instrument right now, and we have nothing but thin structure to retrace into the top end of the range here at 71.5. What a buying opportunity that could be if we make it all the way to the retest, 71.5. Very, very interested if we can get there. The Sailor Shift tool has been firing off a bearish sign for the last couple of weeks, and that has been in force. Let's take a look through total breadth, which continues to deteriorate here, seeing a downtick on the 200 SMA, the green moving average here. It's very subtle, but it's there. Same thing with the 50, and we still remain negative on new highs versus lows. So is there a breadth expansion rally that's underway right now? The answer is absolutely not. Probably sides more with the risk off side of things. Another nail in the coffin could be if the RSP makes a new low inside of this prior balance back here. We'll monitor that with credit spreads, and then we could take a look at the equal weight NASDAQ. You can make a similar argument about 92.25 here, and then we do have those transports, which again we could use as a proxy. This is the Dow Jones transport down here, making these lows excuse me, relative to industrials does look, again, as the theme of today's video has been, a little bit more risk off than anything else. If we look at volatility, it really hasn't ramped up yet. I got a little bit of a pop to the upside, but that's about it, to 2050. So, I think the approach to take here is to just say, like, this is not a dip to buy. This is not like capitulation. Oh my goodness, everybody is like freaking out, setting money on fire and saying like, wow, I can't believe the markets until you see CNBC talking about, oh my God, this is the next sickness crash. It's the next great financial crisis. And the VIX is like up and over 40. Okay, maybe we can start talking about a capitulation style bottom. But for now, this has just been like mild sell side activity. It has not been capitulatory, which in my view means that more selling can come. Right, so that's what I'm carrying forward from the VIX. You make a similar assessment on the VVIX, of course, not accelerating over 120. This will go before the VIX. And then over here, we're still in contango, believe it or not, on the volatility futures, which is, in my view, kind of insane. But it's the nature of the beast, and I think that I would take the same stance as what we talked about on the VIX, meaning that there might be some more room to fall in the downward direction. Let's check in on the core list of companies here. We already talked about NVIDIA. One of a reminder here out of NVIDIA basically is if you're trading options on NVIDIA tomorrow morning, please just make sure you give it enough time, the first 5, 10, 15 minutes, to let the implied volatility settle out of the contracts. I'll give you an idea of the market maker expected move. Oops, we want the clean set, not the cleaner set. Market maker expected move was forecasting 142.38 and 120.13. Talk about market makers getting absolutely paid. Anybody who is swinging big call positions, put positions through earnings, toast. You can kiss that premium goodbye straight into the hands of the market makers. The call writers, the put writers are the ones who come out victorious once again. So all set from that perspective. There's no dynamic hedging that we have to worry about up here or down here. We're opening in range over that 129, at least as of right now. That 129 is going to be critical. The reason I say that is if we just go back to, let's go here, NVIDIA, and let's have ourselves a look-see. If we're over 129, at least, and you could carry this concept forward from the S&P sort of, right? At least this overhead supply, buyers are maybe still doing okay if we can hold on to that 129. If we fall underneath it, we're just back down into the deep seek territory where I think all bets are sort of off in terms of volatility there. I would suggest maybe you have highs, lower high at the 50. And if you get some sort of brigade bolt that looks like this, you could target the Tuesday low. That's an idea, but one step at a time there on NVIDIA. Here it is on the hourly chart, perhaps. So brigade bolt that looks like this comes into this level maybe at 125. Let's go 25 for round numbers sake, and we'll make that the appropriate color as such. There we go. So this could be an idea, minor target, and then the full bottom end of the range at 119 would be the full target. Let's move along, though, to Microsoft, because Microsoft is a pretty ugly looking chart. So, look at this as overhead supply. This chart over the span of the last year or so, year plus at this point, has gone nowhere. It's breaking down from this balance range. We've seen a rejection on today's session right off of the key weekly level. I mean, how beautiful is that? Not beautiful the way that it sort of wicked up above that. A little bit sore about that. But still, from a technical perspective, it did what it should have done off of 403.25. So with that, I think the bears are in control. You have short-term overhead supply here. You have long-term overhead supply here on the daily time frame chart. I don't know how you could be bullish on the XLK if Microsoft, one of the top dogs in that sector, is looking the way it is. So if there's a big one of these that happens over time, fine. Inverted head and shoulders over the neckline 418, the earnings gap close will be glorious. When that setup presents itself, we will be there to participate. But until then, the bears are in control here. That's all I've got on Microsoft. At viel. What do we have on Apple? I wanted the sharp pullback. We got the sharp pullback. Now it's a matter of staying inside the flag range. The flag range being here. We've closed slightly underneath, so 241.25 as a recapture early on in the session tomorrow is critical. If we could get above that and consolidate, or actually I would love to just see this, right? Show me this Brigade Bolt on like a 15-minute chart. Great. I want to go back to the top end of the range. Higher low double bottom over the 50 SMA, 241.25. Let's rock and roll. If the broad market's bearish, am I going to be taking this trade aggressively? The answer is no. If the broad market's going for a counter trend move to the upside, am I going to be taking this trade on Apple? The answer is yes. It's one of the better tech companies, better looking charts in the tech companies as of right now. Amazon, what's going on with Nancy? Let's take a look. Great little lower high opportunity. At 219.25 makes a lot of sense, right? Overhead supply, look above and fail, targets the bottom end of the range, goes through. Don't short it here at the lowest low. Don't chase it down there. This great little lower high opportunity there underneath intraday 219.25. So far playing nicely. I will concede again the point that maybe it's this. Maybe there's something over 219.25. Maybe there's a scalp from A to B. But generally speaking, underneath 219.25, I don't see the reason to be an aggressive bull. I would be thinking about lower high opportunity here. How does this persist? Can we take out today's low? Can we rotate back down through the Tuesday thin structure? Because, I mean, look at this. There's nothing there. It's a V-shaped recovery. Can we get this? Can we participate on continued downside 205.15? That's that. Let's take a look at Google. Google closed the Willow Gap. I think that's noteworthy. On the daily chart, we're obviously not holding up over what could have been seen as like a big weekly Brigade Bolt level. And now we're just coming into the bottom end of the range. So do you want to be short in the hole at the lowest low? I personally don't. I think that this trade has played for the most part. You've seen the Willow Gap close. Great. Kudos. All set. Done. Next idea is just looking for a lower high to be set. That could be bear flag consolidation here and continues. It could be a lower high that's set here. I will change my tone about Google when and if we get this 180.95. Next up, Metaverse. This I think was just awesome. So Brigade Bolt starting to unfold here on the daily, the weekly, you could even say. Retest got pretty darn close at the low of Tuesday's session. Daily 50 SMA there as well, closed over the previous day's high, and there was no reversal underneath the opening print out of the Metaverse. So liking what I'm seeing here, if we're over the devil's in the details numbers, right, 666, if we're over that, I would tend to continue looking for this counter trend in the upward direction. If we take a look at the hourly time frame chart, that would build you out a beautiful inverted head and shoulders. It's much stronger than Amazon's, noting what's happening with this daily bar in particular. So I do like that. Let's move along to Tesla, which has been just the sore spot for the market here recently. I think the thing that we can't ignore, we talked about this over on X a couple posts ago, is this thin structure retracement to the major Brigade Bolt level down here, which is technically there's a gap, right? But if you want the flat level, it's at 270. So, you know, in my view, everything's been going to plan here where you have highs, lower highs, lower highs, lower highs. I think we were, you know, it's never about who's first, who's last, who's whatever, but I think that we were sort of flipped bearish at the appropriate time on Tesla. I'll say that. When we were in a downtrend underneath 377, it became quite clear, you know, we really don't want to be trying to buy this retest in here aggressively. And the key there was that rejection after, let's zoom in on this a little bit as a case study, right? That rejection upper wick right there was the nail in the coffin. If this was going to hold the 358 level and just rock and roll back to the upside, that needed to break out and go. It didn't, right? So just another lower high in the sequence. Obviously, we have the next lowest low, so anything that looks like this, your ideal next lower high is underneath 326.50. Watching that quite closely. Next up, JPM. Financials getting beat up here a little bit. So the main thing on JP Morgan is I think this is doing exactly what it should do. Rejection at 260.60. We talked about this one in the pre-market prep this morning. This rollover here keeps all of, not only this from seller's perspective, but the grind after the thin structure upside, like this is the euphoric earnings breakout. Everything beyond that, sort of the grind, that's all overhead supply now if we're under 260.60. So yeah, we've got an upward sloping 50 SMA. Yeah, it's possible that you get this brigade bolt there, and we'll keep an open mind to that. But for now, if we're underneath 260.60, I would generally take the first approach as being a bear flag below the level and seeking continuation to the downside. Next up, Netflix, and I have a singular trade idea for you today. It's going to be a popular one, I think. What do we have here? Inside of the earnings range, lower high up against the top end of that range. Be my guest if you want shorts on like something that looks like this, risk, reward back down to the downside. It's an idea. I think for a daily reversal, you probably want this for the earnings gap close. We're just not there yet. So one step at a time, but possibly scouting that right shoulder rejection sooner rather than later. Final trade ideas on PLTR. Can you believe it? PLTR, and believe it or not, given all of the conversation we've had so far today, dare I say, this is actually a bullish trade idea. It's a gap fill reversal. It's a daily 50 SMA hold. It is a very tight risk reward setup, I believe. So this will either play or it won't. We will have risk and then reward straight back to the upside, and then the attempt to balloon runners higher. Now, obviously, if this risk off rotation that I've been talking about today is going to unfold, we're probably not going here. But in the short term, if the market does see a sort of relief bounce, if you will, is it possible that Palantir sees a retracement back to $100.50? I think the answer is yes. If we just go on down to this hourly chart view, right, this starts to suggest maybe inverted head and shoulders if we can get a neckline break. So a key level that I did not have mapped out here, I didn't do my homework, but we're doing it here together, right? It's like when, I guess, the teacher comes around and you're scrambling to get the work done before they come to your desk. There we go. 90-80. 90-80. If you can get over 90-80 with a brigade bolt, I think this is possibly an idea to exploit that daily range we were just talking about. Gap fill reversal, daily 50 SMA 84.75 is your key hold. If you notice that Palantir is consolidating below and trading under 84.75, then please, by all means, feel free to avoid this like the plague. There's no reason to try to long this if we are dipping a toe underneath this retest area from back over here. And that's all I've got for you in today's episode of the midweek market update. The big flop from NVIDIA earnings, not doing much to get the market in gear to the up or downside, completely unchanged with just total on par within expectations results from the actual report. That's what I've got. We hope to see you tomorrow morning in the pre-market prep episode. It always kicks off here on the channel. We're live every morning, the market's open at least, at 8 o'clock Eastern time. We'll see you here. We'll get into the pathing. We'll talk about any developments overnight that happen as the foreign markets open up and respond to NVIDIA earnings. But if you enjoyed the episode tonight, if you enjoyed the sort of narrative that we put together around this whole recession idea, instead of just saying hey guys, I think the market's going to crash and just take my word for it, right? I hope it was a data-driven approach. I hope it was not overly biased, right? We just looked at the data points in front of us and came to a conclusion, right? So that's what I've got for you. Hopefully you enjoyed it. Do me a favor, hit the thumbs up button, subscribe to the channel, leave a comment down below, and we'll see you in the next one. Have a green trading week.